I'm Ian Moloney. I'm head of policy and regulatory affairs at Cross River. Thank you so much for joining us for today's the third webinar in our Faster Payments webinar series. Today we'll be discussing tech stacks, embedded compliance, and policy reforms for true financial inclusion. I'm thrilled to introduce Amit Sharma, who's the CEO of FinClusive, and Phil Goldfeder, CEO of the American Fintech Council. Thank you both for being on the panel. It's great to have you. It would be great to just get a quick intro of how long you've been in the space, what your personal mission is, and a little bit about your company, your organization. So Amit, you want to kick us off?
I'm happy to. Thanks, Ian, for having me, and great to be with you and Phil as always. So as it relates to financial inclusion broadly, I think it's been really a lot of my life's work and mission, really starting from development work that I had done, right after college to, joining the Treasury Department immediately after graduate school. And fortunately for me, but unfortunately, right in the throngs of a post 9/11 September 2001 world, and where I had the opportunity to join the Treasury Department and help stand up the Office of Terrorism and Financial Intelligence. The connection to inclusion for us is very straightforward insofar as providing secure, compliant financial access requires governance, risk, and the ability to enter the financial services system in an equitable way and do so in a way that you don't feel like you can get exposed or exploited by illicit actors, which is really the bailiwick of the anti-money laundering, counter-terrorist financing regime that we were working to grow in a post-2001 world. So I've really started there, and as we certainly were in an effort to create governance, risk, and compliance controls to protect the system and its integrity, we certainly saw a number of unintended consequences that actually exacerbated financial exclusion. And so FinClusive is a bit my penance. It's a technology stack around regulatory technology in particular that is really geared toward consolidating and creating efficiencies in the anti-money laundering sphere around a number of the toolkits from know your customer, know your business, monitoring, risk scoring, transaction tracking, and the like, into a workflow that enables financial services of all types, traditional, non-traditional, fintechs, and others, to be able to have a compliant ecosystem, but do so in a way that encourages inclusion. And that's really what FinClusive is about. So if we can marry up the toolkit to protect our systems from abuse and really leverage them as critical business intelligence, we can then engage previously excluded parties, not just individuals, but businesses the world over, into a more secure financial ecosystem. So that's what FinClusive is about, and it's kind of been the whole journey throughout.
Wow, that's a tough act to follow. Let me start first and foremost by thanking you, Ian, and the entire team at Cross River. I know that doing these webinars are extremely valuable, but not as easy to put together as one may think. And so huge credit to you and to the entire team at Cross River for having me and having Amit. Amit is probably one of the prototypical types of companies in fintech that I love to work with, and I love to talk to, and I love to engage with, because the idea of innovation is not simply innovation for innovation's sake, but it's innovation to change the future of financial services for the positive. And unfortunately, too often times, the messages get conflated in fintech, and you hear these stories, you read these stories, and it's so critically important to bifurcate kind of, sort of what the different fintech verticals are, who is within those verticals, and how they're trying to operate responsibly. And so I'm very proud to be the newest CEO of the American Fintech Council. I actually spent an entire career in public service, working for the mayor of New York City, for Senate Majority Leader Chuck Schumer, and I actually served in the state legislature in New York myself. My transition into fintech was simply about how do I continue to find ways to enhance the public good, enhance my public service. And financial technology seemed like the right move, in that when you think about what financial technology does, that it's creating access to financial services, particularly to communities that don't have it. And at the American Fintech Council, we're a trade association based here in DC that represents multiple technology companies across all verticals, but the focus is about a standard. I think what makes us different as a trade association is we're not thinking about industry for the sake of industry, right? We're thinking about industry for the sake of creating standards so that front and center is always the consumer protection. It's always the regulatory compliance without compromising on the service that consumers expect and need, quite frankly. And so, the American Fintech Council represents companies like Lending Club, Affirm, Upstart, SoFi, and many BaaS banks, much like Cross River as well. And so we're excited to represent the positive ecosystem that's looking to make real change for the financial services industry.
Wonderful. Well, it's great to have you both on. And I think before we jump into the meat of the discussion around financial inclusion, I'd like to first have a poll for the audience on, what does financial inclusion mean to you? And there's a few question or answers, responses that we put up, and feel free to answer them at your leisure. We'll jump back to that soon, but I wanted to now kind of pose the same question to the panelists of what what does financial inclusion really mean, and what does it look like? So Amit, feel free to take the first stab.
Sure, happy to. I think traditionally financial inclusion has been really seen through the lens of providing financial access to the unbanked, those that do not have access to traditional banking, a store of account, the ability to send value, make payments, etc. It has been expanded to the quote underbanked, those that may have access to an account, but predominantly may go to alternative services like payday lenders and loan sharks and others. But we've really looked at expanding that definition to the poorly banked. And if you look at it through that lens and look at inclusion, not just ending with being able to access financial services, you start looking at exploitation, you start looking at poor banking, you start looking at inefficiencies in banking and finance broadly that impact households, communities, individuals, small businesses, even whole governments, quite frankly. And this is both exciting from an opportunity perspective in all the manners that Phil talked about before, because we are seeing the greatest innovation in financial services, quite frankly, happening outside of traditional banking. And we're also seeing a lot of that innovation being adopted by traditional bank and non-bank financial services to therefore enable access to markets that they were previously that were underrepresented, to enable efficiencies in financial services, the ability to store value, the ability to access that value securely, the ability to send value securely, making payroll, starting a small business, paying off a loan, etc. And those are really what is exciting. Everything within that context requires that we know who our customers are. And that's the central question of all anti-money laundering and financial crimes compliance. That's the business we're in. And if we look at it through that lens and we think about financial inclusion in terms of both creating efficiencies where inefficiencies, redundancies currently are, where we provide access universally in what is now, in the last 3 to 5 years, certainly, arguably not there in the last 8, 10 years, but in the last 3 to 5 years, is a very globally interconnected and jurisdictionless financial services environment. Today, I can now connect with people in the most remote emerging markets and send a peer-to-peer payment to them. That's awesome. That's exciting for financial inclusion. How do we do that in a way that also provides the right security, protection, privacy controls, and ensure against illicit actors working to exploit vulnerabilities in the financial services system? That is critical. In the same way, why we have seatbelts in cars, right? So how do we provide the right guardrails that are not overly burdensome, but actually efficient to drive business value? And at the end, answer that single question, do I know my customer? Because that's not just a risk and compliance question, that's a fundamental business intelligence question. How do I fundamentally improve the financial services and economic resilience reality for a household, for a small business, for a government, for an institution, for a corporate? And that's what financial inclusion is to us. That's how we look at designing and orchestration of a lot of different services around anti-money laundering and know your customer compliance in ways that service both traditional and non-traditional. And if we can do that by engaging alternative, fintech, banking as a service, peer-to-peer, blockchain enabled and other services with traditional banking, that's what's going to really drive inclusion at scale.
That's a tremendous answer. Let me say two things. Number one is that the beauty of innovation is that it doesn't it doesn't hold us to the rules of the road or the legacy systems that have been around for the last 200 years. Just because we've been doing something a certain way for a long time in financial services doesn't mean we have to perpetuate that and continue that, number one. Number two is those are the systems that are right now leaving behind communities, particularly in rural neighborhoods and minority communities, being left behind without a thought about how we're going to make sure that we're bringing them back. And when you think about innovators, I think Amit touched on two things that I think are critically important. Unfortunately, whenever we see it in natural disasters, right? Whenever there is a need and there's people who are desperate, there's going to be nefarious actors who are going to step in to try and exploit those people. And so it's not just about creating innovation, but creating the guardrails and the standards that are going to enable those consumers to feel confident when they're using it, to feel good that walking into, going online can be just as safe as walking into a bank branch, right? And that is something that I think we need to ensure for consumers. And so how do you do that, right? You do that by working with fintech companies and with various verticals to create those standards so that customers, when they walk through the front door, or they go to your website, or they're utilizing your system, or they're taking out a loan, or they're moving money from point A to point B, they know inherently that there is innovation that was done right, that was focused on a regulatory standard that they've come to know and trust. And I think about my time at Cross River, and I hate to kind of, now it may feel a little bit like stealing when I use this line, right? But like the trust and reliability that you expect from a community bank mixed with the innovative offerings of a technology company. And those ideas are not mutually exclusive, right? There are a lot of big banks who are going to tell you it can't be done without them in the middle. I had the privilege to sit with Director Rohit Chopra of the CFPB at FinTech Nexus back in May. And we were I think a lot of people in the audience were surprised at his comments around fintech and around his encouragement for fintech, because it creates competition, right? And when you create competition, that breeds excellence. And so we don't have to do anything just because that's the way it's been done. I think fintech companies, and Amit is a perfect example, is that there's new ways to crack that egg and continue to service that consumer without compromising on his protections, without compromising on the compliance. And that's really what we do here at DFC every single day, and trying to nuance a lot of these issues. Because unfortunately, right, and Amit is going to laugh, because all fintech is evil and all fintech is nefarious, and everybody who's utilizing innovation is doing something that is intrinsically just wrong. And that's not the case. It's not the case. What we do every day is not just offer the products, but try to tell that story that fintech is providing the opportunity. It's creating inclusion without compromising on the standards.
Absolutely. And I think, that really resonates with me. In my role at Cross River, I deal a lot, obviously, with policy and regulations and trying to figure out that new roadmap to make sure that the responsible actors can really engage effectively within the regulatory environment and not compromise on the compliance and make sure that all the consumers are being protected effectively. So that, really resonates with me as well. So just taking a moment to share the results from our poll, I think a lot of the audience is seeing things in a very similar manner when it comes to financial inclusion. You see that, building products to serve the underserved and unbanked communities is overwhelmingly important, and really where they see the most impact, but also that access to financial products more broadly. To Amit's point about the poorly banked individuals, I think this is getting at that point. So it's good that we're all kind of coalescing around those points. And as we move forward, I'm sure we'll be digging in deeper. So Phil, to you, it would be helpful to understand from a government and policy point of view. And of course, I have my thoughts on it as well. But from your perspective, why is this issue of financial inclusion so difficult to achieve?
Great question. I want to just jump into the poll for a second, because I found, I think the answers were not surprising. I want to talk about the one answer that got no votes in terms of enabling stronger credit. I think it's important to note there's no one product that's going to solve the problem. And I think Amit would agree, right? It requires a suite of products. And and sort of a continuous sort of engagement with consumers to get them into a safe and secure, stable financial future. Enabling stronger credit is a very big part of that. Obviously, I don't think it's step one. I think it's step two as you engage with those products. And we talked, I was on the phone with a member company, Affirm, just yesterday. And with Affirm, when they're reporting and working with the credit bureaus and people are making on-time payments, and there is a clear, transparent, sort of closed-ended product, at the end of your loan, you've actually improved your credit score, right? Whereas historically, that may not have been the case. And that enables you to have an additional optionality as you continue to move forward, which hopefully opens the door to utilizing additional products and additional services. And so I think enabling stronger credit is critically important. Going to your question, Ian, look, change is hard, right? I served in public office, and I can tell you that like a lot of people rather just look at the 5 feet in front of them, right? I could just do that. I don't need to think big because I could just accomplish, these little things. Now, there's nothing wrong with accomplishing little things. You want to do that as you're dreaming big, right? And I hope Amit will agree, like the dream is to do great things. How do you get there? By little steps, right? You make incremental changes. And I think, especially in Washington, and I say this as a Washington and Albany veteran, I can say that in government, it's even harder to think a little bit bigger, right? You see towards your next term, towards your next election, and to really think big about how are you going to change financial services is something complicated on the government circles. Now combine that with the traditional financial services ecosystem, right? Take the traditional financial services ecosystem that is so resistant to change and so resistant, even when facing major challenges. I mean, we saw it back in the Great Recession and post the Great Recession, and we're seeing it now. There are still some legacy financial institutions that are resistant to change. And like I said, combining that with kind of government, sometimes immovability, some people kind of throw their hands up. And that's kind of where we fall in and where Amit's literally nonstop advocacy and education campaign comes into play, because you've got to show the positive aspects. You've got to show what that little change is going to mean, and how, when you stack that on top of change, you really have the opportunity to change the world. And I get made fun of a lot because I'm always the consummate optimist, because I think that I was put here and now at AFC to really change the future of financial services. And we say that a lot. It becomes kind of that cliched talking point, but we mean that. And I know that, in working with Amit and working with our members, the companies that believe in responsible innovation believe that we're changing the world to create that access. And so that's our job. We have to keep talking about it. And webinars like this are critically important for that message and for that goal.
And Amit, really capitalizing on your experience at Treasury, and I think at a really crucial time when you were standing up, and really looking at terrorist financing in the first place, and that's a complex issue. This is another complex issue, regulatory modernization writ large, and how it can really touch on financial inclusion. So, it'd be great to get your perspectives on what can the government be doing to sort of move this along, and what are the biggest challenges?
Yeah, no, absolutely. And I want to echo a couple of things and actually emphasize a couple of points that Phil made that are critical about that central question. In a post-2001 world where, buildings are falling, planes are flying into buildings, where there are very real threats to our homeland, real threats to U.S. national interests, international interests, and the like, that is the baseline for financial enforcement and the growth of anti-money laundering and counter-terrorist financing in a post-2001 world. In that environment, it is not inconceivable to think about a much more enforcement-led strategy where you are trying to proactively do a couple things. One, identify bad people that have perpetrated these horrific acts and understand that those bad people operate within networks that rely on the financial services ecosystem, right? Secondly, deputizing financial services providers, rightly or wrongly, to ensure that they can catch, ideally interdict, illicit activity by appropriately and comprehensively knowing their customer. Not a noteworthy moral and ethically and practical and national security objective, without question, right? And I think that part of the inclusion challenge has been a bit of a part of the momentum of what has been accepted as a financial enforcement-led regulatory set of mandates. And we're seeing that play out even today as we think about new technologies, new types of asset classes, the advent of digital assets and services across an open web architecture. These are all amazing innovations, but if we start to look at governance through the initial lens and filter of financial enforcement, what are all the ways those new innovations, those new services, those new products, those new methodologies can service bad people? We inadvertently do two things. We inherently then throw the baby out with the bathwater, exacerbate financial exclusion, because institutions are faced with a false but binary choice, which has been the world over, and certainly in the US, which is, do I increase with both in humans and costs and technologies, the anti-money laundering and financial crimes enforcement within my institution, or do I include more inside my institution that I facilitate? And we have seen this as a binary choice and as a false binary choice. Because we have done the second thing, we have looked at compliance as a rules ticking exercise, and we have not looked at risk governance and compliance as a critical business intelligence exercise. And that has manifested itself in both regulation and innovation. Phil hit the nail on the head on the innovation side. Innovation is skyrocketing, and regulation will always work to catch up to it. If innovation proactively can demonstrate governance embedded in the system, regulators are that much more equipped to understand how that innovation impacts the policy and legislative framework that we all have to see govern financial services. And that's where innovation must also enable regulation that's going to look and feel different than what it did in the 1960s, 70s, 80s, in the early 2000s and post 9/11 world. That's what's exciting. So a couple ways to do that. The sector driving governance from a policy perspective. We have been a part of the Compliance Finance Inclusive Working Group, where we devised a rule book with the sector. Digital asset companies, Web3 native companies, financial technology companies, non-bank entities, saying, look, how do we look at technology and operations in a new financial services environment? Jurisdictionless, web native, peer-to-peer, non-intermediary. And how do we take that anti-money laundering set of best practices and now put that in a new technology and operating bucket? And how do we create a policy framework that comports to the very intent of the financial system of security, consumer protection, and integrity? That's the start. Innovation, therefore, has to then embed that governance to showcase it's not just resilient to illicit activity and exploitation, but it is inclusive. So regulators need to start now also opining and evaluating sound anti-money laundering stacks on the level of inclusion, right? It is a very exclusionary argument to evaluate AML effectiveness, because effectively bank examiners go in and say, hey, let me see all your threats and let me see how you're mitigating them by excluding said activity. How about flipping the model and saying, how are you including activity that previously wouldn't get that access, and you're doing so in a secure environment? We have to flip the model from a regulatory innovation perspective, not just in terms of the obligation it purports, but also how the innovation embeds governance. And the final piece I would say is that that Phil rightly pointed is incumbency is the biggest threat of all, period. And Brian Brooks told me this, the former acting comptroller of the currency, really astute, that it is just much easier for policymakers, legislators, even incumbent institutions, and we're seeing this with the big traditional banks, to keep that innovation slow, keep the regulatory moat deep, so that entrants are resisted in some way. That's a natural, what they say, natural way of market conditioning. And I think that's fun. I think that we need to look at innovation as the future, not just in terms of how we provide that greater access, how those technologies do so, but how they do so in a much more secure environment. The good news is that in my lifetime, in my professional lifetime, we are seeing tools in technology in web native forms, using tools like blockchain technology, distributed ledgers, digital identity credentialing, etc., that actually embed governance of immutability, transparency, auditability in the very system of how assets are issued, how they're transacted, and how they're held, which is the fundamental point of banking. And that's exciting. And when we can marry the two, which hats off to Phil for embracing that broader challenge and saying, how do we get the sector and governance to align in that way? And hats off to companies like Cross River that want to be forward-leaning in enabling companies that are actually providing that access. And there was a question in the chat around how does this comport to third-party services, right? There's an explicit a set of guidance in there that your third parties should be diligent, not in terms of just their controls, but how they're in fact embedding those anti-money laundering and financial crimes controls into that system. And that is critical, not just because you want to check the box, because you want to know your customers better, you want to know them comprehensively, and you want to be able to service them with the right financial services and products that increase economic resilience. That's the key. And I think that marriage is close.
Absolutely.
Ian,
And I think, oh yeah, go ahead, Phil.
Yeah, I wanted to highlight one point, which, and again, Amit was right on the money. I would say is that there's something he said, which really struck me, is that there's a significant mismatch between the innovators and the regulatory agencies that are charged with overseeing them. And unfortunately, they're not moving at quite the same pace. And that is creating a much less stable environment for the institutions and the fintech companies that are trying to offer the services, right? I mean, Cross River sort of led in the sector, but there is a tremendous amount of community banks that are getting into the BaaS banking world who are looking for the guidance, who are looking for, and this is not 2012, right? We're at 2023 and moving quickly into the future. Regulators need to keep pace with the innovators because ultimately the innovators are solving a problem in a safe and reliable way. And to the third-party risk management and sort of how do you think about your partnerships, there are a lot of companies that are looking to do it the right way. And a lot of our members who are looking aggressive in their transparency in trying to do it the right way, regulators kind of have to keep up to ensure that we're able to offer the best possible service to consumers in the safest possible way.
Absolutely. And I think really, to kind of summarize the points that you both were making, it really seems like we need to, at this time, focus on realigning those incentives between the regulators and their examination models and what risks they're looking at and their understanding of compliance, not just as that rule, box ticking exercises screaming into the void at sometimes, I'm sure it feels like to some of our audience members, but to actually make that part of the focus of their work, and that there's a positive feedback loop and not just that one-sided affair. And, from the real world perspective, I remember in the early 2010s, there was de-risking on the Southwest border where banks were being, kind of pushed to have less interactions with those that might have needed financial services the most because they presented an undue risk to those financial institutions. And that was before the tech that we have now was able to reach them and mitigate some of that potential risk or assumed risk. And so, going to Amit, thinking about FinClusive's work, compliance as a service, what's at the root of that? How are you building that into your financial inclusion and making it just that next level of important to any financial institution that's willing to kind of lean a little bit forward on compliance?
Yeah, thanks for the question. And there are two sub questions, whether you meant it or not, in your question, and that is one, what is compliance as a service, which I'll get to in a second, and what truly is a financial service, right? Because those are critical when we think about what this technology applies to. What we recognize from government experience, regulatory, supervisory experience, etc., is that as we continue to grow the regulatory compliance burden, the set of obligations around know your customer, transaction monitoring, client monitoring, scoring, etc., reporting, is that a number of solutions came out in the market. They continue to be propagated and innovated. And there's some pretty awesome solutions around identity verification validation, document verification validation, know your business and legal entity registries, things like that. There are great technologies out there, but they're often piecemeal and point solutions. So the average institution, whether you're a small credit union or community bank, a global exchange, an international correspondent bank, a non-bank financial services company, a money service business, a fintech, you have to piecemeal these different capabilities in one service architecture that often has a lot of humans in the loop, a lot of redundancy, and a lot of a lack of data interoperability. And we said, wait a second, that is what's helping to grow the cost and inefficiencies that we're seeing in compiling a risk management and compliance infrastructure. So we said, what if we took best-in-class capabilities the world over, 30, 40 different providers hundreds of analytics tools, hundreds of global watch list screening and due diligence elements we bring into one workflow. So we deliberately look at the marketplace of regulatory technology solutions and say, how can I partner with those solutions? How can I integrate and orchestrate those solutions so that we can have global coverage, so we can have redundancies where we may not have mismatches in capability, so we can have service level of agreements so that banks, financial technologies, from the very small to the very large, from the traditional to the alternative, be able to plug in API enabled, web-based, to be able to then have that coverage to fulfill either parts or the totality of their financial crimes compliance stack from a technology perspective. And then we go one step further to say, here's a policy framework, because every one of these organizations also demonstrate a policy framework for anti-money laundering, know your customer, sanction screening, risk scoring, and the like. And here's a policy framework that's that helpful guide. And by bringing the two together, you have one contract, one set of technology integrations to, a service of globally provided orchestrated elements. That's key, and you can do it securely. And then on top of that, we have innovated several capabilities around digital identity credentialing. Running through KYC or KYB and being attached to a unique digital credential that can serve as a utility for KYC among partners. So imagine coming in with a fintech, having that credential through a KYC store, and then say, "Oh, your lender, instant KYC. Oh, your deposit institution to custody that value, instant KYC. Oh, you want to on-ramp to a digital asset like a stablecoin, instant KYC. You've got a wallet that you want to tie to your account, instant KYC." That creates utility in the system and efficiency in the system because you've globally architected it. And that's what's key. So that's what compliance as a service is in a nutshell. It is an architecture and orchestration of a number of providers, capabilities, and tools in one service workflow. Importantly, it's built for both traditional and non-traditional. So it can augment the small credit union or community banks know your customer and onboarding, as well as being able to do blockchain analytics and ACH and wire analytics for transaction monitoring, because you've got multiple rails of payment, right? So it's got the ability to toggle on and off capabilities across the financial crimes compliance stack that's equally applicable to that third-party solution, to that fintech, to that banking as a service, to that crypto solution, to the traditional bank that just wants to grow its deposits and access ACH and wire rails. And this is where we're having a lot of really interesting and innovative dialogue with Cross River, right? How do you engage not only companies from a service offering perspective? How do we build compliance as a service offering to your own clients? But how do you then extend that compliance footprint in ways that is a force multiplier to all of those that are engaging you in markets that you never served before? And now you're not just attacking the traditional low, moderate income unbanked. You're attacking the ability to have an individual in a diaspora community in the US use a digital asset to peer-to-peer pay someone in need in Pakistan, in Venezuela, where there's a sanctions program, right? You can do it securely with monitoring, etc. That's what's critical. And our overall economic resilience goes up. And I would say that our national security interest is therefore enhanced. And that's what the criticality of these financial services companies mean. So it's no longer just about the bulge bracket banks. In fact, the innovation's happening at that small and medium tier institution. It's happening in the community institutions that are forced to innovate. And quite frankly, this is where the incumbents are going to be forced to say, do I want to embrace that? Do I want to keep going and creating these regulatory moats? Or do I want to keep de-risking them? We have been a victim of de-risking too from bulge bracket banks like Bank of America. And we're a regulatory technology company. So we have to overcome these with technology and capabilities, and we're excited to do so.
Absolutely. And Phil, leveraging your experience with me at Cross River and now your broader industry-wide vantage point, it would be great to get a sense of, for those that are on the call that are thinking, maybe they're at a financial institution, maybe they're at a fintech company, and they're thinking about what are the keys to engaging and shrinking that regulatory moat. What's your advice? What's your view on that?
Thank you. And again, it's a perfect question, because I think a lot of people tend to sort of focus on their business, on what they're trying to accomplish. And they look at some of the peripheral things as, they're not as important. They're not as, I can't afford to do them now. I'm a small startup. And I get that answer a lot. Well, we're a small startup and we don't have the time or the bandwidth to engage with regulators or policymakers. And my answer is always the same when I turn around and I say, you don't have to do it now. You're not forced to do it now, but that means someone else is doing it for you, right? And I don't see that in a good way. I want to be clear about that. I'm not saying that someone else is doing it for you, don't worry about it. It means that someone else is sort of having those engagements, having those conversations, and dictating and creating the rules of the road. Whether your company is good or not good, you're not a part of that conversation. And so you fundamentally don't get a seat at the table. But even more importantly, think about sort of what you're doing today and you find a way to do it. There's no certainty tomorrow. I think the biggest challenge for any fintech company is the regulatory uncertainty, is the policy uncertainty of what's going to happen in a year from now. And so today we're able to operate, but who knows, right? Politics is shifting. And we just wrote an op-ed sort of touching on the CFPB. And if the CFPB were to go away based on the potential Supreme Court decision, what's that going to mean to some of the certainty that some of the CFPB rules have created? It goes away and it creates more of a turmoil, and you see regulation by enforcement, which is something none of us want to see. It seems sometimes we're just so small, we don't have the bandwidth, we don't have the funds to do it. But sort of the investment, the small investment today will pay dividends in the future. Now that's, again, sometimes it comes as a cliche. It's like, oh yeah, everybody says that. And I tell you that I've seen it. I've spent my entire career in government where, even as a policymaker, I've reached out to certain industries to talk about the future, and I may refuse to engage because, well, we're making money, our business is profitable, I don't have to think about that. Only to see them be out of business today, many years later, to be out of business because they did not think about that. And so this small investment in the outreach, in the engagement, in the education is going to pay dividends, not just for your bottom line, but for your business model and the entire ecosystem to survive and ultimately thrive. We're trying, again, I said this earlier, we're trying to change the future of financial services. I think from Amit, and you hear him and you hear the energy and you hear the enthusiasm, but more importantly, you hear what he's doing, right? For smallest banks to the largest banks, right? You hear what his technology is enabling, the regulatory structure that it's infrastructure it's inherently building into the process. If we're not engaging, it's going to be very easy for a policymaker to overlook what he's doing. It'd be very easy for a regulator to say, or for big banks to dismiss him and say, this is not important. Because again, for the reason we discussed earlier, change is very, very difficult. And so I think to his credit, what Amit is doing, what all of our members are doing, right? They're making an investment in the future of financial technology and the future of financial services. And I will tell you in my time at Cross River, and I know Ian, in the work that you do, it's already paying dividends, right? We're already seeing the changes going back to 2015 and 2016 and 2017 as the products evolved over time and different fintechs started to blur the verticals and nobody was in a single space. The idea that we're cultivating a responsible, innovative culture and then putting that message out there enables you to determine and define the rules of the road that will provide the service to the consumer and make sure that he's protected at the same time.
And, I want to key in on a couple of points that you made, Phil, around, and Amit as well. The competition, I think, is key. And we're seeing some of that, as it relates to CFPB and their Dodd-Frank 1033 rulemaking around data. And I'm hopeful that we start to see that throughout, sort of a whole of government approach, that we need to have more of that competition within the market, because ultimately, touching on what we discussed before, that can help realign those incentives. So that way we as companies are engaging more proactively, looking for opportunities to serve consumers because our bottom lines depend on it. So, the other point though I'm wondering about is how much of this is really required by the regulators. And I know there's a lot that isn't necessarily required. So it would be great to get your perspectives on what should be required. So Phil, you want to take a first stab at that?
Yeah, I'll say this just in a very pragmatic way. It's happening today, right? The incumbent legacy players in the financial services ecosystem are shifting their business models to meet what they're seeing as real competition from online lenders, from payments companies. from what was once small community banks who have now evolved into to BaaS banks and infrastructure providers. You're already seeing legacy players sort of transition and change their business model. And I think, going back to what Director Chopra said and has said a number of occasions, is that competition ultimately breeds excellence. And in business, we often talk, and especially in banking, we talk about the stickiness of a customer. And these were the director's words, right? Stickiness is not because it's complicated to leave, right? Like that's not what stickiness should be, where it's so hard to get my money out of one bank and put it in another bank, and so I'm not going to move it. That's not breeding excellence. That's sort of a race to the bottom, where like, how do I create more and more bureaucracy to keep my customer and my consumers stuck? What we're talking about is competition. That stickiness is about, I'm getting amazing service. And so if I was able to work with a company and get an amazing product, whether it was a loan, buy now, pay later, and earned wage access, you know what? I really like that company. I want to get my direct deposit and put my funds there. I want to use it to transfer money between one account and another account. I want to use it to set up investment accounts for my kids, right? And you're seeing more and more as these fintech companies continue to evolve in the various verticals. And the reason why sort of American Fintech Council kind of changed our operating structure to be a lot more inclusive of companies that no longer speak a single language. But all of this is already having a tremendous impact on legacy companies. And on the policy front, I think policymakers have to recognize that, and they have to embrace that as well. And I think you're seeing a lot of that in the talking points. I think the challenge for us is now the devil's ultimately in the details and how it's going to be put into place. And how are those policies going to be implemented? I mean, we spend a lot of time working with state legislatures on bills, on proposals, but ultimately, even once those bills are passed and signed by their respective governors, we then have to work with the regulators in those states to see how those bills in the legislative language is going to be put into process, and then ultimately how it's going to have an impact on the financial services ecosystem in that state. And so there's no one answer and there's no quick answer. And I know, unfortunately, people don't like to hear that, but it is a long process. And I've had the privilege of seeing the process and sort of working on the inside, sort of from beginning all the way to the end, working in legislatures and ultimately in executive offices. And I can tell you that those companies that start early, that are consistent, that are continuing to put out a positive message about how they're ultimately serving consumers in a safe way, those are the companies that are going to be successful.
Yeah, and I can build on that with Phil's response. And I think a couple things that are of note that are quite difficult as regulators look at policy frameworks that can govern the space, and the space being a very rapidly evolving financial services environment. Phil said something really important that I think is really critical for this broader webinar, and that is it takes an ecosystem to drive inclusion in a way that leverages the technology. No single provider is going to solve inclusion or bank universally, period. Right? I mean, we saw the efforts of Citibank in the late 1990s, 80s and 90s try to be the sort of universal bank and then having to scale back. We've seen a number of other financial services providers trying to expand capability. How have the most successful financial services providers really expanded capability? By partnerships, by integrations with third parties, which reinforces the earlier question of how do we embed governance and risk and compliance tools in that context. And I'll tell you, compliance as a service is that model. Compliance as a service is a recognition that it takes an ecosystem of providers. I'm not trying to compete with the best identity validation provider. I'm not trying to compete with and build the better blockchain analytics capability. I'm not trying to compete and build the best transaction monitoring case management engine. I'm going to integrate those capabilities into a single service architecture, into a workflow that benefits organizations that need that service set. What we see today in risk governance and compliance that goes to somewhere between 20 to 30+% of the operating budget of most major institutions is governance and compliance. Why? Because they have to piecemeal a lot of these capabilities with a lot of humans in the loop, with a lot of redundancies and inefficiencies, and net, when I put that up, they say, oh, wow, it cost me 10, 12 bucks to onboard that low-income individual. Wow. But if I don't look at two things, one, integrating and bifurcating that cost in ways that not only benefit the lifetime value of that customer, what Phil said before, right? If I get one service from them can I provide other services to that company through my my infrastructure? And I'm going to only do that by partnering with others that can do that kind of service. And that's what we're seeing a lot of innovative financial services companies do, is that they recognize that it takes a village, it takes an ecosystem. Compliance as a service is a village. It's a village of compliance providers across the entire financial crimes compliance stack in a workflow. And what we benefit from is to be able to go to each individual provider and say, who are the customers you're serving that want one or more of these other capabilities? We can bring them to bear. And together, we can not only grow revenue, but we can grow that stickiness. And stickiness, as Phil says, is not just so make it harder for the client to leave, make it sticky because you're making our services that much more compelling for them and their affiliates, their household, their family, their small businesses, and the like. When we do that, we create efficiencies in the system in a secure and compliant way. And then there was another question around how does that interoperability therefore get integrated in the stack? And it can be, for us, it's create web-based interfaces so you can literally log in and do everything native to the online environment, create API interfaces that can plug into core stacks and ERP, risk management systems, and sales management systems, customer relationship management systems, and the like. And when you can create those efficiencies, you reduce humans in the loop, you increase data interoperability and security, and you start creating a utility around compliance that is equally about business intelligence and value, not just about let me root out illicit finance risk or tick the box for the regulators so when they come and do their supervisory exam, it's okay, they're above board. And everything belies what's called a risk-based approach, right? Regulators look at the banks and say, you should take a risk-based approach. And the risk-based approach is say, how do I look at my clients and evaluate their risk? How do I look at my infrastructure and what's that risk exposure to me? And how do I marry it so that the mitigating factors actually enable greater service securely, not disable it or exclude it? And that's what we need to do here. And that's where these technologies are really fascinating to engage into the ecosystem.
Absolutely. And I think connecting it to the financial inclusion angle, it's really about lowering the costs and the burdens for the business so they can start putting that funding somewhere else to actually serve consumers. And I know that's been very important for us at Cross River. You know, we handle a lot internally and make sure that our compliance is, you know, we always strive for the gold standard, but we're looking for ways to make it more efficient and make it more effective. So that way we can ultimately, you know, pass that benefit on to consumers. So, you know, one of the areas, and I think Amit, you know, this will resonate with you quite a bit, that is, you know, is kind of a tricky area, is around digital identification. And before we jump in there, I just wanted to have another brief poll for our audience to see, you know, have digital identification tools kind of been top of mind, or have they fallen away, you know, in favor of some others? So we'll give the audience a chance to respond to that quickly. But while they're doing that, you know, Amit, let's discuss sort of FinClusive's solution to digital identity.
Yeah, no, absolutely. And thanks for that. Digital identity, we believe, is somewhat central to modernizing know your customer processes and broader financial crimes compliance in 4 fundamental ways. One of the biggest cost issues and efficiency issues is know your customer verification, even after you've done it once with a particular institution, because all those affiliates, but even within the same institution, there are some organizations that have 14, 15 different gateways that they come in the institution. You come in through private client, you come in through insurance, you come in through credit, you come in through mortgage. And if you want another product or service, they're re-KYCing you in that same institution. Cost doesn't make any sense. And digital credentialing, digital identities that are backed by that KYC data can do instant verification. So it creates a utility within an institution and a network of institutions. Imagine onboarding to a credit union in a member cooperative environment and being able to be verified and validated by another. Imagine, you know, being onboarded by a fintech company that's a customer of Cross River that then can be completely KYC enabled and utility within the entirety of the Cross River environment, right? For deposit taking, for funds transfer on ACH and wire rails and the like. The second is creating privacy protection, right? This is where the consumer, the CFPB comes in. We are now more and more exposed in a native digital online world. And therefore, we are, I would argue, in the last 3 to 5 years, more and more aware that our personal privacy information is there for the exploitation. Digital identity credentialing allows us to move to an environment where we can control our data, control the privacy characteristics of our data, our social security number, our driver's license, our selfie, etc., and be able to disclose that to those that need to verify it without having to constantly expose it. And that has tremendous value to record keeping. It has tremendous value to law enforcement trying to look at transactions associated with a particular individual or entity. It has a really good application to the travel rule compliance, where constantly right now we're exposing PII and account information across intermediaries, but imagine just having the credential travel across. Number three, it allows us to create efficiencies across providers that may not be in a network. So now, using things like zero knowledge proofs, you can KYC Ian without having to disclose the underlying attributes of his selfie, liveness, SSN, device ID, email, phone, etc. You can actually disclose the requisite information to KYC across that and verify and validate. And that's hugely important. Finally, I would say is that the digital identity space is really popping, right? And there's so many things, from digitization of paper-based IDs all the way to healthcare and education records. So there's a tremendous application in financial services when we think about the Bank Secrecy Act, when we think about Know Your Customer, and importantly, now you're looking at financial infrastructure and providers that are interconnected simply because they are integrated partners. We need to be able to use credentialing for know your client, know your customer in those environments that now can be cross-border. And that's what's exciting, because when I send value to diaspora in another community that has a bank regulated in another market, you want to be able to ensure that that institution can say, the sender is legitimate, the receiver is legitimate, and that credential can travel in that way. So there are 3, 4, 5 different areas where we're excited about the identity credential and the KYC back credential that we created in allowing those utilities, privacy protections, and network capabilities at scale.
Wonderful. And I'll share the results quickly from our poll. And it looks like overwhelmingly, people are seeing really the importance of that digital identification tools, and that it is top of mind. And even for the few, that said no, but it should. So I think there's really some of that that's resonating. And Phil, just recognizing a lot of the different regulators that are involved in this, what are you seeing the challenges, or what challenges kind of exist from regulatory and from a market side for digital identity?
So I'll just say sort of the consistent problem we have is that there are a number of regulators that are engaged, and that's just when it's on the federal side, right? You start to think about the payments infrastructure, the regulatory payments infrastructure that's happening in the states level. At the states level, it makes it even that much more complicated to, again, sort of make sure that there's a recognition and understanding of what companies like FinClusive are doing to oversimplify to simplify the problem and find real life solutions. Interestingly enough, and someone asked earlier about the third-party guidance. I think what was so interesting about the third-party guidance, number one, is that the banks that were thinking about it the right way were already compliant with that. They were already doing that. They were already taking full responsibility over their partner companies. They were already engaging in full oversight over the technology partners. What was so interesting about it was, for us at the American Fintech Council, was two things. Number one is that it was a unified guidance, in that for the first time, really, in this instance, you had all three agencies coming out together, which is right off the bat, before they even put out a piece of paper or say one word, when they're coming out and they're working together, it makes it easier for the ecosystem to engage. I met with a bank in New York City a couple of weeks ago who was interesting, that I was sharing some stories around the FDIC and the OCC, and they were a Fed-regulated bank, and said, oh yeah, we saw that exact thing, or that exact example demonstration from the Fed as well. And yet all three agencies were going their own ways related to that specific regulatory issue that they were having. And so when we saw the unified guidance, I think that was a really good sign, at least to the larger fintech ecosystem, that the regulators are finding ways to work together to provide increased clarity. Number two is, there is this thought, right, from many, that fintech is inherently unregulated, right? Fintech is an unregulated Wild West, and it is unregulated, and nothing could be farther from the truth. It's quite the opposite. In the case of Amit and in RegTech, fintech is the regulatory structure, right? Like, that is the RegTech is the regulatory structure. And so it's quite the opposite. They're not just regulated, but in many cases, they're doing it better than many traditional community banks. And so it is critically important that the federal government, when they do put out these rulemakings and they do put out guidance, they make it clear to state regulators and to state attorneys general that there is a semblance of regulatory structure, and that they are working to ensure that the banks and the financial institutions, the fintech companies that they oversee are regulated, and that the dual system, where sometimes important, unfortunately creates even more uncertainty for a lot of the companies that are actually trying to increase the regulatory infrastructure for the consumer. And so again, there's no one answer. And we look for the slight steps in the right direction, and we keep pushing forward to ensure that the story keeps getting put out there and that we're able to find ways to continue that unified approach to make sure that companies understand what the processes that they have to follow in order to be compliant and make sure they're offering the safest products to the consumer.
Absolutely. I think that's very well put. And, looking at the time, I know we could probably discuss this for multiple more hours, but I did want to quickly turn to a question from the audience about the future of regulation, and to get both of your, very brief thoughts on what's your thoughts on AI-based document and policy generation tools, and are they the future, or are they going to cause more problems than solutions?
Well, I can jump in quickly. Look, AI is here, and the ability to use machine learning, advanced analytics, natural language processing, and other artificial intelligence tools, I think provides us tremendous opportunity. I think like at the top of this call, Phil said it, importantly, AI falls squarely in this, is that innovation must not only ask the question, can I do something, but should equally be asking the question, should I be doing something? And how do we appropriately ensure that we red team applications of artificial intelligence? How do we look at information that may be of historical bias that's going into AI tooling that they derive from to create everything from credit scores to faster lending practices to just policy and procedures for documentation review, as per the question, right? We need to make sure that the governance around the AI tooling is equally robust to get to the intent, so that we prevent garbage in and garbage out. AI tooling to rapidly expand the capacity, efficiencies of processing, especially data, in all of these areas is a massive boon. If we can do things faster, cheaper, and can do these mathematical equations at millions in speed instead of tens, that is hugely beneficial for all of us. If we can orient the appropriate information in, the tooling and algorithms and questions that are asked inside the machinery, and the outputs and how they're interpreted. If we do that well, then AI tooling is hugely beneficial to inclusion, financial system and financial markets infrastructure, and policymaking. That's where I'm long the tooling, but very careful and cautious as we apply it.
Amit said it exactly right. And the only thing I'll add to that is I had the opportunity to hear Senator Majority Leader Chuck Schumer talk yesterday at an event with Tech NYC, where there's always a hesitancy when the government gets involved or steps into a space like this. There's always a nervousness that, are they going to do it the right way? And I'm happy to report that the senator was not resistant to it, but quite the opposite. We're going to explore this the right way. We're going to work with the companies who believe in that standard to make sure that we are monitoring what's going in, to ensure that there's no, as an example, bias going out, right? I think we have to be very, very thoughtful about this. And the commitment thus far, and oftentimes, and I say this as a former regulator or legislator, is that there's what we call reactionary legislating, right? And we see it all the time across the country, is that there is this impulse that something happens or something goes wrong, or there's some story written somewhere, and all of a sudden we have to move and we have to put out regulation. And I don't think that's always the right approach. Sometimes yes, most of the time no. I think taking a thoughtful approach to understand the systems, to understand where things are going right and where things are going wrong, and understand, again, the nuance, right? There's a very different thing between Chat GPT versus like AI and underwriting, right? You're talking about two very, very different things that you need to understand before you put blanket regulation or blanket policy on top of that. And I give Senator Schumer and the bipartisan senators that are working on this issue a tremendous amount of credit, because they're going out to be as thoughtful as possible to make sure that we're doing this the right way.
Absolutely. I think pragmatism really is the most important piece when it comes to effective legislation or regulating. Thinking about the regulation by enforcement of the old, APA style, that really is less than optimal. And the good rulemaking, I think, is, where it gets notice and comments and, really leverages that industry perspective, I think is really helpful. So recognizing it's 1 p.m. on the East Coast, the school bell has rung. I want to first thank our audience for, holding on and listening diligently and all the great questions. Our panelists, Amit, Phil, thank you so much for joining me. This has been illuminating. If you feel like you want to get more information from these two, they've been gracious enough to give us their email addresses, which we'll post in the chat. And if you really want to dig in deeper, there's a webinar from my friends over at AFC on AI and the solution. Is it the solution to regulatory modernization? Lastly, our next webinar on faster payments will be coming, and we'll be bringing Plaid to the virtual stage. So keep an eye out for that, and we look forward to bringing it to you. Thanks everyone again. This was a great pleasure of mine. Have a good day.